Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$144.42. That was the closing price on February 13th, 2026. You might look at the screen and, see a flat day, a marginal, 0.26% rise and think nothing really happened. But if you zoom out, that number is, it's screaming. It represents a capitulation.
Oh, it is brutal. We are effectively tethered to the 52-week low of 140.59, just to frame the sheer scale of this destruction for everyone. In February 2025, so exactly 1 year ago, this stock was trading at $281. We are looking at a 50% drawdown. The market has taken a blue-chip enterprise software giant and just cut it in half.
And this selling pressure hasn't stopped. I was watching the volume on February 9th. Over 9 million shares traded hands during that 5% drop. That is not retail investors getting nervous about a headline. That is institutional liquidation. That's funds, puking the stock.
It is chart damage that takes years to repair, and we have to look at the RSI, the Relative Strength Index. It hit 26.52 earlier this month. For those who don't spend their day, staring at technicals, typically anything under 30 is considered deep oversold. It implies the selling has been so aggressive, so relentless, that a bounce is statistically probable. But the fact that it's staying there tells me this isn't just a dip.
And see, that is where we diverge. I see that RSI of 26, I see a 50% haircut on a company with these financials, and I see a massive disconnect. The question isn't whether the chart is ugly. We all know it is. The question is this a macro bloodbath that is indiscriminately punishing a high-quality asset, creating a generational entry point? Or is this a fundamental valuation reset, where the market has decided that enterprise software simply isn't worth what it used to be?
I think it is the latter. I really do. I think the market is waking up to a new reality where SaaS doesn't command a premium anymore. The era of paying 10, 12, 15 times revenue is just, it's over.
And I think the market is reacting emotionally to a strategic pivot that is absolutely necessary. I'm looking at a company with operational excellence that is being treated like a distressed asset. While everyone is panic selling based on the chart, I'm looking at the Q3 fiscal year 2026 financials.
The financials are backward-looking, though.
But they tell us about the health of the engine. Revenue is up 12.6% to $2.43 billion. Subscription revenue, the recurring cash flow that stabilizes the business, is up 14.6%. But the real story, the one the market is ignoring, is efficiency. Non-GAAP operating margins hit 28.5%. That is up 220 basis points year over year.
You can cut your way to profitability, but you cannot cut your way to growth.
They aren't just cutting, they are printing cash. Free cash flow grew 53% to $550 million. So you have a company growing its cash flow 5 times faster than its revenue. At $144 a share, this stock is trading at roughly 14 to 15 times earnings. For a company with this margin profile and this dominance in the human capital management space, that is a historical anomaly. You usually only see multiples that compressed on companies that are shrinking. And Workday is not shrinking.
I see why you rely on those metrics, I do, but I come at it from a different angle. The market is a forward-looking machine, and it is screaming that the growth paradigm is broken. You mentioned the revenue growth, but look at the market cap history. The 5-year CAGR, the compound annual growth rate, for Workday's market cap is negative 3.73%.
That is multiple compression. That is sentiment, not a business failure.
But sentiment is the valuation. That is my entire point. Multiple compression is the killer. The market refuses to pay for steady growth anymore. We are resetting to a world where these big SaaS platforms trade at 4 to 5 times revenue, not 10. And the technicals confirm this. We have a death cross on the chart.
Ugh, I hate that term.
It sounds dramatic, I know, but it is a standard technical signal. The 50-day moving average is at 196, and it has crossed below the 200-day average of 218. When the short-term trend falls below the long-term trend, it signals a structural bear market. It tells algorithmic traders to sell every rally. It becomes a self-fulfilling prophecy.
technicals are just market psychology drawn in lines. I mean, they don't reflect intrinsic value. If the business executes, the lines will change.
But will they execute? This brings us to the core reason for that recent 9 million share sell-off, the leadership instability. You cannot ignore the timing of the CEO swap.
I knew you would characterize it as instability. I see it as clarity.
How is it clarity? On February 9th, 2026, they announced Carl Eschenbach is stepping down. Eschenbach was the operator. He was the, quote, adult in the room who brought discipline, who tightened the screws on the sales org. And now you bring back the co-founder Anil Buxeri, and you simultaneously announce a 2% workforce reduction, cutting what, 600 roles? To an outsider, that looks like panic. It looks like the board woke up, saw the stock dropping, and just hit the emergency eject button.
That interpretation misses the entire strategic context. This isn't panic. It is a founder-led pivot that is essential for the AI era. Eschenbach did exactly what he was brought in to do. He disciplined the operations, he expanded the mid-market reach, he fixed the margins. We just talked about that 28.5% margin. But we are not in an operational efficiency war anymore. We are in a technology war.
So you fire the guy who knows how to run the business.
You don't fire him. The mission changes. You are swapping a general known for sales execution for a visionary known for product. The market is terrified of AI disrupting SaaS. So who do you want at the helm? The sales guy or the founder who actually built the platform? That $135 million restructuring charge, that isn't just cutting heads. That is a necessary pill to swallow. They are clearing out non-revenue generating roles in global customer operations to free up capital for AI and international expansion.
That sounds noble, but it brings us to the substance of this pivot. The strategy is Workday Illuminate, and they are talking about shifting from a database to an agent system of record.
It is the only strategy that matters.
But is it real, or is it just marketing wrapper?
It is a massive differentiator. Most AI out there is just a wrapper around the large language model. It's a chatbot that summarizes your email. Workday sits on over 1 trillion annual transactions. That gives them semantic context that no one else has.
Okay, hold on. Explain semantic context for the listeners, because it sounds a lot like buzzword bingo.
Okay, think about it like this. If you ask ChatGPT who is our best salesperson, it doesn't know. It doesn't have the data. If you feed it a spreadsheet, it might just hallucinate an answer. Workday holds the system of record. It knows the org chart, the quota attainment, the tenure, the salary history. So when Workday's agent answers that question, it isn't guessing. It is pulling from a source of truth.
I get the theory, but I question the ROI. You mentioned the financial audit agent.
Yes, early customers are saving 900 hours per year on their financial close process. That is real. That is tangible money saved. They aren't just summarizing text. They are automating the drudgery of accounting.
900 hours is a great headline, but I am sorry, I just don't buy that the market is ready to pay a premium for this digital labor yet. There was an MIT study recently that highlighted only 5% of organizations are seeing real bottom-line ROI from general AI investments. Everyone is experimenting, very few are deploying at scale. Workday is betting the entire farm that their specialized agents are the exception to that rule.
Because they are the exception. General AI fails because it lacks context. Workday is the context.
Even if the tech works, is it monetizable? Or is this just a defensive moat? Maybe they have to build this just to stop customers from churning to Oracle or SAP. That doesn't necessarily mean they can charge more for it. It just means they survive.
They absolutely can charge for it, and that is where the new pricing model comes in, the flex credits. This is the lever that changes the math.
That is a lever that introduces massive risk.
No, it aligns them with the customer. 38% of enterprise buyers say they prefer consumption-based models because they hate seed bloat. You know how it is. Companies pay for 5,000 licenses and only 3,000 people log in. CFOs hate that. Workday is moving to a model where you buy a pool of flex credits. You use them for user seats, or you can use them to run these AI agents. It lowers the barrier to entry.
And it removes the safety net for Workday. The beauty, the absolute holy grail of the traditional SaaS model was predictability. You paid for the seat whether you used it or not. Rain or shine, recession or boom, Workday got paid. Now look at the macro environment. We are seeing a slowdown. If companies start hiring fewer people or if they just decide to run fewer audit reports to save credits, Workday's revenue drops instantly.
But the backlog gives us visibility. The 12-month subscription revenue backlog is $8.21 billion, up 17.6%. That is a massive cushion.
That backlog is healthy, I will admit. But the growth rate of that backlog is slowing. It used to be consistently over 20%, and now you are introducing a variable pricing model right when IT budgets are being rationalized. It feels like they are adding volatility to their revenue stream at the worst possible moment.
I would frame it differently. They are seeding the market. By including flex credits in contracts, they get customers hooked on the agents. Once a company realizes the financial audit agent saves them those 900 hours, they aren't going to turn it off. They will buy more credits. It is a land and expand strategy for the AI age.
There is another expand strategy we need to discuss, and it is the elephant in the room. We have to talk about the legal risk. Mobley versus Workday.
I knew you would bring this up. The bears love this case.
We have to bring it up. It is a class action lawsuit certified for older workers, 40+. The court has ordered discovery on the hired score tool. The allegation is that Workday's algorithmic screening discriminates against older applicants.
It is an allegation, and Workday has a very strong defense.
But let's look at the structural implication here. This isn't just a bad headline. This attacks the SaaS liability shield.
Break that down.
Historically, software vendors are just tool makers, right? If a company uses Excel to create a discriminatory hiring plan, Microsoft isn't liable. The employer is. But with AI, that line blurs. If Workday's algorithm makes the decision to reject a candidate, and the court decides Workday is liable for that output, well, that is a massive regulatory cap on their entire agentic AI ambition.
Workday's defense is that the ADA, the Age Discrimination in Employment Act, doesn't apply to applicants in this context. And more importantly, they do not train on protected characteristics like age or race.
But you know as well as I do that algorithms find proxies. If you train for technological adaptability, you might accidentally filter out older workers. If they lose this case, or even if they settle big, it chills the adoption of these HR agents. Companies will be terrified to turn them on.
It is a known risk, I grant you that. But I argue the greater risk is irrelevant. They must push AI to compete with SAP, who is very strong on compliance and payroll in 50+ countries, and Oracle, who is winning in manufacturing. Workday has to take this legal risk to maintain its technological edge. They can't just stay in the bunker.
So they are betting on AI execution, betting on a new pricing model, and betting against the courts, all while swapping CEOs. That is a lot of moving parts for a company trading at 4x sales.
Let's talk about that multiple. You keep saying 4x sales like it is a ceiling. I view this as a generational opportunity. Let me just walk you through the math on how we get a return from here.
I'm listening.
I am looking at the path to a 5x return over the next decade. So, projecting out to 2036, that puts the share price at roughly $720.
That seems incredibly ambitious, given the momentum we just described.
It is rooted in capital allocation, not just hope. Even if revenue growth slows down to the low teens, look at the buybacks. They have a $5 billion authorization through fiscal 2027. They are generating $2.2 billion in free cash flow annually. If they use that cash to retire just 3% of shares per year, the share count drops from 268 million today to about 197 million by 2036.
That's financial engineering.
It is shareholder return, and you combine that with margin expansion. They are targeting 35% non-GAAP operating margins by fiscal 2028.
Targeting is the key word there.
They are already at 28.5% and climbing fast. The leverage in this model is insane. If they hit 35% and they reduce stock-based compensation to 13-14% of revenue, which they have committed to, investors will pay a premium again. Even without massive multiple expansion, simply holding a steady valuation on that earnings growth gets you close to 700.
That requires perfect execution in a world that is messy. You are assuming the valuation multiple holds or expands. What if the software apocalypse is permanent? What if 4.2x sales?
which is where we are today, is the new ceiling.
At 4.2 times sales, yes, the math gets harder. They would need to reach $45 billion in revenue to hit that target. That is a 17% CAGR. It is tough, I admit. But if the AI bet pays off, if those agents actually work, 17% is achievable.
That is a massive if. And you have smaller, AI-native startups nibbling at their ankles. You have LLM-native HR tools that don't have the legacy code debt Workday has. They can move faster.
But they don't have the data. I keep coming back to this. The moat is the system of record. Companies are not going to rip out their core HR and finance system for a startup. The switching costs are just too high. Workday is sticky.
Sticky, yes. But high growth, that is the debate. If they become just a sticky, slow-growth utility, they are not a 5x opportunity. They are a bond proxy, a utility company.
And right now you are buying that bond proxy at a discount that implies it is going out of business.
Or I am buying a falling knife.
Look, let's wrap this up. For me, the sell-off to 144 is an emotional overreaction to a complex but necessary strategic transition. You have $2.2 billion in free cash flow, a founder returning to drive innovation, and a clear roadmap for AI monetization. The death cross is a backward-looking indicator. The product roadmap is forward-looking. This is a gift for patient capital.
And I maintain caution. The technical damage is severe, and the transition from sales-led under Eschenbach to product-led under Boustry is fraught with execution risk. The market is deleting value from SaaS multiples, and until that stops, Workday remains vulnerable.
The outcome of the Boostry era and the adoption of flex credits will be the deciding factors.
Agreed. It determines if Workday remains a Rule of 40 giant or if it becomes a legacy utility.
We will see if the market has correctly priced the risk of the AI transition.
Only time and the next earnings report will tell.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.